You've probably heard the phrase buy, borrow, die thrown around online, but most people have no idea how literal it is. While the middle class earns, spends, and gets taxed at every step, the wealthy follow a three-step system that quietly turns assets into tax-free cash for life. And once you see how it works, you'll understand why income is the worst kind of money you can make. If you've ever wondered why the richest people almost never earn a real salary, here's the reason. Income gets taxed the hardest. So the ultra-wealthy avoid it entirely. Instead, they buy assets, borrow against them, and then pass everything down without ever triggering the taxable event the IRS is waiting for. My name is Alex, and I spend a ridiculous amount of time studying the financial structures the rich use, the ones nobody explains to regular people. If you enjoy breakdowns like this, go ahead and subscribe so you don't miss the next deep dive. Because here's the question nobody ever answers clearly. If the wealthy don't sell their assets and don't take a high salary, then how do they get the money they live on? Today we're unpacking the exact mechanics behind buy, borrow, die, and why it flips the entire wealth game upside down. Number 1, the illusion of wealth and income. Most people grow up believing wealth is just a bigger version of a paycheck. More zeros, nicer titles, bigger bonuses. But the higher you climb, the more you realize something strange. The ultra-wealthy don't actually earn money the way everyone imagines. They're not sitting around waiting for a huge salary deposit to hit their checking account. In fact, many of the richest people on the planet intentionally report salaries that would barely cover rent in a major city. And the reason is simple. Income is the most aggressively taxed form of money you can make. When you earn a salary, the IRS takes its cut first. You get paid second. The rich don't play that game. They avoid income not because they're allergic to cash, but because income creates friction. The more you earn, the more you owe. And eventually, the tax bill grows faster than the money itself. That's why Elon Musk went years earning a base salary of zero. That's why Jeff Bezos took home around $80,000. That's why Warren Buffett has kept his salary at $100,000 for decades. These aren't symbolic gestures, they're strategic moves. Here's the part most people never question. If billionaires earn almost nothing in income, then what exactly are you seeing when headlines say one of them made $20 billion last year? You're seeing asset value, not cash. You're seeing stock appreciation, not a paycheck. Their net worth rises because the companies they own grow, not because someone wired them millions. And once you understand that distinction, everything starts to click. Wealth isn't about income. Wealth is about ownership. It's about controlling assets that get more valuable without triggering taxes. The rich don't work for money. They position money and the entire tax code to work for them. Number 2, the real wealth engine, equity, not cash. Here's the part that flips the entire money equation upside down. The wealthy don't focus on earning cash. They focus on owning things that grow while they sleep. Equity is the real engine behind wealth, and once you understand how it works, you can immediately see why the rich avoid income like it's a leaking bucket. When a CEO gets paid, they're not getting a briefcase full of dollars. They receive stock options, restricted shares, slices of a company that can quietly multiply in value without ever showing up as a taxable paycheck. For regular people, income is oxygen. For the ultra-rich, income is a liability. It's loud, it's visible, and it's taxed before you can even use it. This is where the realization principle comes in, a concept the wealthy live by even if they never say the words out loud. You don't pay taxes on gains until you sell the asset. So if your shares are worth $1 million today and $5 million next year, you owe nothing unless you cash out. Your net worth can soar by tens of millions, and the IRS won't knock on your door because technically you haven't realized anything. Think of it like owning a house that quietly appreciates every year. If it rises from $100,000 to $1 million, nobody sends a tax bill for the $900,000 in value you gained. The wealth sits there, untouched and untaxed. That's how billionaires operate across every category of their money: stocks, real estate, private companies, investment funds. Everything compounds inside the asset. And here's the key insight most people miss. If your wealth lives in appreciating assets, you can grow richer every year without earning a single taxable dollar. That's the foundation that makes the entire buy, borrow, die strategy possible. Number 3, why the wealthy never sell anything. Once you understand how powerful unrealized gains are, the next move becomes obvious. You never sell the thing that's making you rich. Selling is the moment the tax bill wakes up. Selling is the moment you turn invisible wealth into taxable income. And the wealthy avoid that moment for as long as humanly possible. When most people think about money, they think in terms of cash flow. How much is hitting my account this month? But wealthy people think in terms of asset flow. How much is my ownership growing? These are two completely different games. One keeps you stuck in the cycle of earn tax spend. The other lets your net worth rise silently without handing over a percentage every time it grows. Look at it through simple math. If your stock grows from 1 million to 5 million, selling forces you to hand a chunk of that 4 million gain to the government. But if you hold it, you pay nothing. And meanwhile, the asset keeps compounding. That's not an accidental loophole, it's the realization principle working exactly as designed. This is why wealthy families build their fortune around long-held assets. They don't flip houses, they accumulate them. They don't trade stocks, they compound them. They don't chase quick profits, they let time do the heavy lifting. Selling is a last resort because selling breaks compounding, the one force working harder than any salary ever could. And here's the part regular people rarely see. The rich can live incredibly well without ever selling a thing. They can buy homes, fund businesses, travel the world, and cover any expense they want, all while their assets stay perfectly intact. How? That's where borrowing enters the picture, and it changes everything. Number 4, the middle class trap, high interest debt. Before we get to how the wealthy borrow, we need to look at how everyone else borrows, because the contrast is the entire point. For most people, debt is not a tool. It's a trap. And it starts with the way regular households are forced to borrow using after-tax income. Take a standard mortgage. A $250,000 loan at around 6.85% over 30 years means a monthly payment of roughly $600. Stay on schedule, and you'll send the bank about $576,000 in total, more than double what you borrowed. And here's the part that stings. Most of your first decade of payments goes straight to interest. You're not building wealth. You're renting your own home from the bank until further notice. The same pattern repeats across credit cards, auto loans, and student loans. Interest rates jump from 18% to 25% to even higher, and every payment you make comes from money the IRS already taxed. You earn $1, the government takes its share, and whatever's left still isn't yours, because the bank gets its cut next. This double squeeze is what keeps the middle class trapped. You pay taxes to earn the money, then you pay interest to use the money, and the principal barely budges. Meanwhile, the system doesn't view you as stable. You might feel middle class, but to the bank, you're a risk. Someone whose income could disappear, whose savings are thin, whose job is vulnerable. That risk gets priced into every loan you take. Higher interest, less flexibility, more pressure. It's the opposite of how the wealthy borrow. And that's the detail that makes the buy, borrow, die strategy possible, because their debt works in their favor, not against them. Number 5, why banks see regular people as high risk. Here's the part nobody enjoys admitting. To a bank, your income matters far less than your stability. You can make $150,000 a year and still be considered risky if your savings are thin, your job is uncertain, or your debt is stacked high. Meanwhile, someone making $40,000 but owning their home outright might look like a safer bet. It feels backwards, but it makes perfect mathematical sense to the bank. Banks don't lend based on how much you earn. They lend based on how likely you are to keep paying. So they examine everything that signals reliability, your credit score, your debt-to-income ratio, your employment history, your emergency reserves. If any of those pieces look shaky, the interest rate climbs, not because the bank dislikes you, but because risk has a price. And this is where the middle class pays the penalty. The system assumes your income could stop at any time. It assumes you might lose your job. It assumes an unexpected expense could derail everything. So when you borrow, you pay a fear tax, a premium baked into your interest rate, to compensate for the possibility of failure. But wealthy people live on the opposite side of that equation. They're not borrowing against their paycheck. They're borrowing against assets, real estate, stock portfolios, private companies, things that don't disappear overnight. To a bank, that looks like near zero risk. And here's the twist. Because regular people pay high interest to borrow, they get poorer. Because wealthy people pay almost nothing to borrow, they get richer. The system isn't moral or immoral, it's simply designed around risk. And understanding that sets the stage for the next step: how the rich borrow in a way that actually builds wealth. Number 6, the rich borrow differently. This is the point where the entire system splits into two completely different realities. Regular people borrow because they need money. The wealthy borrow because they already have money, just not in cash. And that single difference changes everything about how banks treat them. When the average household takes out a loan, they're borrowing a large amount relative to what they own: a $40,000 car loan, a $300,000 mortgage, a stack of credit card balances. In many cases, the loan is bigger than their savings, bigger than their investments, and sometimes bigger than their entire net worth. That imbalance makes them high risk by definition. One bad month, one missed payment, one job loss, and everything collapses. Wealthy borrowers operate on the opposite end of the spectrum. They borrow small amounts compared to what they already hold. If you own $20 million in assets and borrow $5 million, the bank sees virtually no risk. You could miss a payment for months and still have more than enough collateral to cover the loan. That's why interest rates drop to 2, 3, sometimes even 1% for private bank clients. Low risk equals low cost. And here's where the loophole quietly emerges: because their debt is backed by enormous stable asset bases, wealthy borrowers aren't beholden to monthly principal payments the way regular people are. They can roll loans forward, refinance them, restructure them, or expand them as their assets grow. In other words, they borrow without sinking. The middle class borrows and drowns. This difference is the entry point to the buy, borrow, die strategy, a system where borrowing isn't the end of the road, but the beginning of compounding. Number 7, Phase 1, buy, acquire appreciating assets. Everything in the buy, borrow, die system begins with one simple word: ownership. Not income, not savings. Ownership. Because the wealthy don't try to stack cash, they stack assets that grow while they're not looking. And the first phase of the strategy is all about building a foundation that compounds quietly year after year. The rich buy things with a long-term appreciation baked in: stocks that expand as companies grow, real estate that rises with demand and inflation, private businesses that generate cash flow, intellectual property that earns royalties. Even farmland and fine art sit in this category. None of these assets pay the IRS a single dollar until they're sold, which is precisely why the wealthy hold them for decades instead of chasing quick flips. Consider how CEOs are compensated. Stock options, restricted shares, equity grants, all engineered to reward ownership, not cash flow. While regular people get a paycheck that shrinks after taxes, the wealthy collect slices of companies that quietly double, triple, or 10x in value. And as long as they don't sell, the IRS can't touch a cent of it. The math is simple: if a portfolio rises from $1 million to $5 million, that $4 million gain is completely untaxed as long as it stays inside the asset. The same rule applies to real estate. Buy a property for $2 million, watch it appreciate to $6 million over a decade, and you owe nothing unless you sell or refinance. This is how wealth snowballs: not through hustle, not through raises, through patient ownership of appreciating assets. But appreciation alone doesn't pay for jets, homes, staff, or everyday life. To unlock that purchasing power without triggering taxes, the wealthy move to Phase 2, the part of the strategy that feels almost unreal to anyone outside their world. Number 8, Phase 2, borrow, turn assets into tax-efficient cash. This is the point where the strategy stops looking theoretical and becomes shockingly practical. Because once you own appreciating assets, you unlock a financial door almost no regular person ever gets access to. You can walk into a bank, pledge a portion of your holdings, and walk out with millions without selling a single share and without triggering a single dollar in taxable income. Here's how it works in the real world. Let's say you have $100 million in Amazon stock or a portfolio of commercial properties. You don't want to sell because selling means taxes. So instead, you visit a private bank, Goldman Sachs, JP Morgan, Morgan Stanley, and they evaluate your holdings. They don't care about your salary, they care about your collateral. And with strong collateral, the rules flip completely. For stocks, banks might lend you 50% of the value. For real estate, 60 to 70%. For extremely stable assets, sometimes even more. That means your $100 million portfolio could unlock a $50 million line of credit at 2 to 4% interest. Not 20% like a credit card, not 7% like a mortgage. A tiny number that barely dents your net worth. And here's the magic. The wealthy can use that borrowed money for anything: homes, travel, cars, jets, investments, philanthropy, business ventures, all without ever reporting income. Borrowed money is not taxable, it is not income. And because their interest payments are low, sometimes even deductible, the cost of accessing this liquidity is tiny compared to what their assets earn each year. Meanwhile, those assets keep appreciating. A $100 million portfolio can become $150 million over time, allowing even more borrowing, more reinvesting, more compounding. This is how the wealthy live luxuriously without selling anything. Borrowing doesn't shrink their net worth, it expands it. Number 9, why banks love this game. If you've ever wondered why banks bend over backward for wealthy clients, here's the truth. The rich aren't borrowers, they're business partners. To a bank, a wealthy client is the closest thing to guaranteed profit you can get in finance. Their assets don't call in sick, their real estate doesn't quit, their stock portfolio doesn't miss payments. In other words, they're not lending to a person, they're lending to a fortress. Think about the difference in risk. When a regular borrower takes out a mortgage or car loan, the bank is gambling on their future income. If that income disappears, the bank is forced into collections, repossessions, and losses. But when the wealthy borrow, the bank isn't relying on a paycheck. They're relying on multi-million-dollar collateral that grows over time. From a risk perspective, it's like lending with a safety net made of steel. And because the risk is so low, the bank charges lower interest. 2%, 3%, sometimes even less. But the real profit isn't in the rate, it's in the relationship. Wealthy clients don't just borrow, they invest through the bank. They keep their family office there. They use the bank's estate planning, trust services, insurance products, and private funds. Every one of those services generates fees, commissions, and long-term revenue streams. So even if the bank lends at a tiny interest rate, they still win, because a wealthy client can be worth millions in lifetime value. That's why private banks protect these relationships at all costs. They offer flexibility regular people never see. They allow interest-only loans. They roll credit lines over for decades. They customize terms to keep high net worth borrowers happy. This symbiotic relationship is the backbone of buy, borrow, die. The wealthy get ultra-cheap liquidity. The bank gets decades of predictable profit. And both sides quietly benefit while the middle class plays by a completely different set of rules. Number 10, Phase 3, die, erase the tax bill legally. Here's the part that feels almost unreal the first time you hear it. The tax bill that's been building for decades simply disappears at the end of a wealthy person's life. Not reduced, not minimized, erased. And it happens because of one quiet provision in the US tax code called the step-up in basis. To understand how powerful this is, imagine a simple example. Decades ago, someone buys $1 million worth of Apple stock. Over time, that grows into $10 million. If they sold it while alive, they'd owe capital gains tax on the $9 million profit, a bill easily north of $1.8 million, but the wealthy don't sell. They hold until the end. Because the moment they pass away, the cost basis of those assets resets to their market value. Overnight, the taxable gain evaporates. The heir doesn't inherit the stock with a $1 million cost basis. They inherited it at $10 million. If they sold it the next day, they would owe exactly zero in capital gains tax. Legally, automatically, silently. This rule applies to stocks, real estate, private companies, art, land, almost anything with appreciation. And it's the final piece of the buy, borrow, die formula. Grow assets tax-free, borrow against them tax-free, pass them down tax-free. But what about the loans taken along the way? High net worth families plan for that too. They purchase large life insurance policies, often inside irrevocable trusts, designed specifically to wipe out outstanding debt when the original owner dies. The insurance payout clears the loans. The heirs receive the assets clean, unencumbered, and with a stepped-up basis. It's one of the most efficient wealth transfer systems ever created, and it exists in plain sight. Number 11, how the loans disappear after death. At this point, the strategy sounds almost too smooth. Buy assets, borrow against them, never sell, and let the tax bill vanish at the end. But there's still one practical question left. What happens to all the borrowed money? The loans didn't just evaporate, right? And this is where wealthy families reveal just how meticulously planned their financial systems are. The rich don't leave loose ends. They engineer their estates so precisely that even the debt becomes part of the design. Here's how it works. Throughout their lifetime, a wealthy individual might borrow tens or even hundreds of millions of dollars backed by their assets. They use that borrowed cash to live, invest, and expand their wealth. all without creating taxable income. But they also know those loans need to be settled eventually. And instead of burdening their heirs with repayment, they use one of the most powerful tools in estate planning: permanent life insurance held inside an irrevocable trust. This isn't the kind of insurance policy you see in TV commercials. These are multi-million-dollar plans specifically structured so that, upon death, the insurance payout flows directly into a trust outside the taxable estate and is used to pay off outstanding loans. The bank gets its money, the debt is cleared, and the heirs receive the underlying assets fully intact with a stepped-up basis and zero capital gains tax. It's the final cleanup step, and it's remarkably effective. No tax on appreciation, no tax on the borrowed money, no debt passed down. Just clean, generational wealth transferred with surgical precision. At this point, the entire system snaps into place. The rich live on borrowed money, their assets grow untouched, and the tax bill never arrives. Number 12, final insight: own the system or serve it. When you zoom out and look at the entire cycle, buying assets, borrowing against them, and letting the tax bill vanish at the end, the truth becomes uncomfortably clear. The wealthy aren't playing a different version of the game. They're playing a different game entirely. One where income is optional, taxes are minimized by design, and wealth compounds without interruption for decades. Meanwhile, most people are stuck in a system built around the opposite incentives. You earn a paycheck and get taxed first. You borrow with after-tax dollars at the highest interest rates. You pay for homes, cars, and debt using money that's already been shaved down. You sell assets to access cash and trigger more taxes in the process. Every move feels like a step forward followed by 2 steps back. Not because you're doing anything wrong, but because the rules were never explained to you. The buy, borrow, die strategy reveals something deeper. The real engine of wealth isn't effort. It isn't hours worked. It isn't even income. It's ownership, assets that appreciate, leverage that's cheap, time that compounds quietly behind the scenes. The wealthy don't escape the system by avoiding responsibility. They escape it by understanding how incentives actually work. And here's the most important takeaway: you don't need to be a billionaire to apply the principles. You don't need a yacht, a private banker, or a trust attorney on speed dial. You just need to shift your mindset from earning to owning, from selling to holding, from spending to compounding. Because in the end, the system rewards one thing above all else: those who control assets. Own the right things and the system works for you. Own nothing and you work for the system. Key takeaways: wealth isn't built by earning more. It's built by owning more. The buy, borrow, die system works because it flips the traditional money cycle upside down. Instead of relying on taxable income, the wealthy store their wealth in appreciating assets, let those assets grow untouched, and avoid triggering taxes by never selling. Liquidity comes from borrowing at extremely low interest rates using their own assets as collateral. Borrowed money isn't taxable, and the cost of borrowing is tiny compared to how fast their portfolio grows. The system closes with the step-up in basis, a rule that erases decades of taxable gains the moment an owner passes away. Heirs inherit assets at their current value, not their original purchase price, which means entire fortunes transfer without capital gains tax. Even outstanding loans are handled through estate planning, often using life insurance inside trusts to pay everything off. The core message is simple: income is expensive, ownership is powerful, and compounding works best when nothing gets interrupted by taxes or forced selling. You don't need billions to apply the principles, just the mindset shift from working for money to letting assets grow for you.